Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
Hello, everyone. Today I have a special guest, Joe Fairless. You're a person who I've been respected and admired for many years in the multifamily industry. And thank you for coming on the show today.
My pleasure. Looking forward to our conversation.
Thank you. Joe Fairless is a co-founder of Ashcroft Capital, which has over $2.8 billion of assets under management. In addition to his responsibilities, Joe created the podcast Best Real Estate Investing Ever, Advice Ever Show, which is the longest running daily podcast show, and there's over 500,000 monthly downloads. So wow, that's a pretty impressive a podcast show and downloads, Joe.
Thank you.
Thank you. So please tell the audience about a little how you got started and create this massive company, the $2.8 billion amassment, which is pretty massive. So how did you begin that?
I began by making mistakes and learning from the mistakes, and then applying the lessons learned from those mistakes. So let's see. The first mistake I made that is relevant for this conversation would be I had $1,000. So I graduated from Texas Tech, was making $30,000 out of the gate as a junior project manager in New York City. So I went from Lubbock, Texas to New York City right out of college.
Okay.
And I had $15,000 in student loan debt. My check every 2 weeks was about $750.
Yeah.
So needless to say, I didn't have any discretionary income or much, and I wasn't saving anything. But as I climbed the corporate ladder, which I did relatively quickly, I started saving money. And I finally got my first $1,000 that I saved, and I made my first mistake. And that was, I was walking down the street in Manhattan. I remember seeing this giant poster in the window of a bank, and it said CD and I forget what it was, like 1.9% for 12 months, whatever it was. And I thought, well, okay, that's more than I'm making now in my savings account. So I gave them my only $1,000 that I had. They held it hostage for 12 months. And then I was like, okay, I'm so excited to see what the returns are. Well, I should have known, obviously. It was like $19 or something. It was something ridiculous. And then I got taxed on that money later. I was like, this is not the way to go. And so then I started reading some books, Rich Dad Poor Dad. I read Investing for Dummies. They talk about investing in stocks, bonds, LLCs, and real estate. I gravitated towards real estate. And then I made another mistake. I thought that buying single family homes would provide the amount of cash flow that I had on my spreadsheet prior to purchasing them.
Right.
And on the spreadsheet, those single family homes look great. But in reality, that $250 a month I was making from those single family homes would be wiped out when they moved out. Because then it'd be $3,000, $4,000, and then I'd have to get it rent ready again and wipe out the profit. So I realized, hey, I need to do something larger at scale in order to really make a mark on the passive income and building my net worth.
Okay. And how did you learn about multifamily syndication? Was it a mentor, or did you hire a mentor, or you just stumbled into it by mistake and you found someone?
It was. So I read the book Apartment. I read many books on apartment investing, and I reached out to the authors. And one of the authors had a consulting program, so I hired him as a consultant while I still had my full-time job.
Yeah.
So I would do regular calls with him. He taught me how to underwrite apartments. It was not as refined as you'll see nowadays for, hey, here's how you do syndications. I don't even know if it was called, it wasn't even, I don't even think we called it syndications back in back in the day, back in 2012, 2013.
Yeah.
I don't remember. I'm sure that's technically what it was, but so I hired someone. He gave me a very broad level education, or high level education, I should say,
Mhm.
on apartment investing and syndication, and that got my momentum going.
I think I know who it was. I think I know who your mentor was. I remember this in one episode. Okay.
Yes.
Great. 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 And then I think you were in New York City. You were a salesperson. You were a salesperson in New York City trying to,
I worked at advertising agencies, so I was on the
okay.
account side. So I mean, I guess everyone on at an agency is effectively in some sales role, or
Yeah.
aren't we all in business at some
Yeah.
point? At some aspect of our role is sales, but I was an account executive, so I ended up being the youngest VP of a agency on the account side,
Yeah.
where I just work on accounts, and I work with the creative team to come
Hmm.
up with ideas that resonate for the target audience.
And I think what one of your well, I listened to you. I think one time you say, I mean, I felt obsolete if I was later on and keep doing it. I'd be obsolete because I'm out of my age limit or something. Is that correct? Your thoughts?
Of what? Sorry, I missed that.
Like basically, I think when you're like in your young age, you're in your prime time, you can
Hmm.
do a lot of sales in New York City and hustle and bustle.
Oh,
But
right.
I
Yeah.
think at some point later on, you said that you were older, and maybe you weren't in your prime time, you might be obsolete in doing that
Yeah.
role.
Yeah, well, uh it's New York City is a great place from my opinion. New York City
Yeah.
is a great place as a single young professional.
Okay.
Uh but uh I didn't want to be there as um a married, someone who wanted to eventually have a wife, which I now have, and a family, which I now have. I didn't see myself being there for that stage of my life.
Okay. Okay. So I guess so you hired a mentor, you read his course. He inspired you to do multifamily, which now we know is syndication.
Mhm.
Before it might be called multifamily investing. We don't know the
Yep.
term was. It was. And I guess where was your first apartment building you bought it? Where was that located?
Cincinnati.
Oh, Cincinnati, Ohio. Okay. Well, how many units was
Mhm.
that one?
168.
Okay. Now, were you afraid? Because it seemed like a very large building for a first deal. Were you afraid of raising capital or getting the deal done?
It is a very large deal for your first one. I went from four single family homes to 168 unit, and we didn't technically buy it. We uh, got it control over it via a master lease with option to purchase. And as a result of that type of deal structure, it was uh, much less down than what you might need. And we didn't have to get approved for a loan. I didn't have to get approved for a loan because I didn't have the net worth or liquidity to get approved, or by the way, the background or experience,
Yes.
for single family homes. So that was the first deal, and that was an absolute train wreck. It was
Oh,
everything that could go wrong went wrong, and it was my fault. It was, all the mistakes that I made, lack of due diligence, great, a good to great growing submarket. That was part of the due diligence that I did well, but bought it or took control over it at a little too high of a price. But more importantly, and most importantly, the I thought the property was stabilized and cash flowing when in reality it was distressed from an economic
okay.
occupancy standpoint. I learned the distinction between occupancy and economic occupancy the hard way. Occupancy, people living there; economic, the people paying to live there,
Yeah.
and the economic was much lower. And so that property ended up losing money. I
Oh,
had 12 investors in that deal. I had 12 challenging conversations with those investors, and I said, I don't know how long it's going to take, but I'm going to pay you back plus 14% return out of my own pocket.
yeah.
And I did over the years. I did, and one of them has invested with us over 20 times, and another, has wrote a 2-page handwritten letter to me thanking me. And that was before I met my business partner now. That was before we formed Ashcroft. That was just a deal that I did prior to that. And yeah, I learned a lot of lessons. Yeah, I moved to Cincinnati to live in the model unit to try and turn it around.
Yeah.
I would pack up my stuff in the morning. I would walk to the leasing office. I would um I would then go try to lease the model, lease other apartments by showing the model unit. My toothbrush would be on the counter, my
Yeah.
clothes might be,
Yeah.
I say,
Wow.
pack it up before.
Yeah.
Um, and uh, I would go to Home Depot, get the asphalt from Home Depot, like the little asphalt fillers I'd put in the
Hmm.
trunk of my Corolla, drive it down the back to
Wow.
the property and shovel that stuff out at an
Wow.
evening. So I was very hands-on, but what I realized is that we can be hands-on and try really hard, but it won't be enough for some challenges.
Hmm.
We've got to have the ability to cut our losses or try a majorly different approach.
Hmm.
And
And
and so that's what I ended up doing.
but have you thought of hiring third-party professional management company to help you turn it around, like a big company locally or something?
Yeah, yeah, there's a third party management company. I didn't set them up for success though, because I didn't raise the right amount of money on the front end, because of the lack of due diligence. Uh, and so it just was undercapitalized out of the gate, and then it was just a disaster. So so there's maybe some things here or there that I could have had better help on, but I mean, when you set something up for failure, it's that you're the reason why it happened. And so I realized it's a really good business model, but how I was executing it was poor at the time. And I realized I need to focus on what my strengths are, and I need to find a business partner who can help me with the areas that I'm not strong at or
Hmm.
I'm really bad at. And so that's what I did. I ended up meeting my business partner as a result of this, and then we bought our first property together, and off we went. We bought it for I think like 14 or 15 million dollars, and about a year and a half, 2 years later, it appraised for 21.6 million.
Wow.
Cash out refinance, returned a lot to investors, and off we went. So I was like, oh, okay, that's how the business model's supposed to go.
Yeah.
And I learned from that. And obviously every deal we learn things, and it's
Hmm.
just how do we continue to optimize.
Right. Every deal is unique. And when I did like my 10 deal I done, every unique is very different. You learn every single time you do a deal because it's a unique nuances, maybe a local market or something. So you gotta cater to those local nuances to make sure you do it right. Otherwise, you could be in trouble.
That's
So
right.
so I guess your takeaway from lesson is that in your first deal, you didn't do enough due diligence. That's why you don't have enough reserves or capex or something. So is that the reason?
That's a close cousin to the main takeaway. I'd say the main takeaway for the first deal is that um, I should have identified all the components that are required to be successful, and then looked myself in the mirror and said, which ones can I be really good at, and which ones do I have no experience or I wouldn't be good at, and make sure I have those gaps filled before proceeding.
I see. I see. So basically, one man can't do it. You need a team. You need a team to help you to do it. You can't do it
Well,
yourself.
yeah,
Yeah.
one man, one woman might be able to, but not this man. Like I
Just,
need I need a team. I'm sure there are men and women who can do it on their own, who have the well-rounded expertise. And I might know of a couple off the top of my head, but this guy can't. I have a skill set that is in a certain area, and I do not have skill sets in other areas that I can compete at the best level at.
And what do you say is your strong suit that you excel at, Joe?
Well, to do deals, you need the deal. You need
Mhm.
to have money to buy the deal, and you
Hmm.
need to execute the business plan.
Yes.
And so I would say the money to buy the deal, and the investor relations is something that I have a background in,
Yeah.
from my advertising days. I was working with clients, and uh, I was working at advertising agency. So, and my major's advertising.
Yeah.
So I would say that would be my specialty.
Okay. Okay, great, great. So let me ask you, so what formula you took to go from, I guess, one, two assets to now? Because, and then you have a fund now too. That's interesting too, because you did single asset syndications. And
Mhm.
what made you, I guess, shift to a fund model versus single asset?
Well, and now, so we went from single assets, and then we did, after that we did three funds, and now we have under contract a single asset that we're purchasing, and we can talk about that in a little bit. Um, the reason why we switched from single assets to a fund is because we had good deal flow.
Yeah.
There's many reasons, but one of which is that we had good deal flow, and uh, investors, uh, in a fund can invest $100,000, and that it'll be spread across 4 or 5 deals,
Yeah.
and their risk will be diversified.
Yes.
Whereas with a single deal, you're in on that one deal. So that's why we did the fund. One of the reasons why we did the fund, and why we went back to a single deal, in this one in particular, Braxton, that we're buying in Orlando, is because we don't know what the deal flow is going to be. There's a the transaction volume and is tight, or is low, I should say. The transaction volume is low for multifamily, and we can talk about why if you'd like. But transaction volume is low, so I don't know how many deals we're going to buy, but I know we're going to buy this one because it's an incredible opportunity for where we're at. I think we're in a once in a generation buying time right now,
Mm-hmm.
and we can talk about some numbers behind that, for why I think that, if you'd like.
Yeah, Joe, I agree with you because I was thinking of creating a blind fund, kind of like you, and buying a couple of assets in multifamily. But what I realized was maybe it's not enough deal flow, and maybe it's harder to convince, in my opinion, in a blind fund, an investor to invest
Yeah.
blindly with you, unless you're strong as your track record, right? But
Mm-hmm.
I'm not as senior as you, so it's more difficult to
Mm-hmm.
convince average investors to invest $100,000 or $50,000. So I decided to continue the single asset route because I've been doing it for 10 deals already. So it'll be my 11th deal or something. So I agree with that. And deal flow is an issue because it's for the past year, I haven't seen much deal flow. It's what I heard. I mean, I have 1 year, I haven't done a deal. And so that's a common theme in our world. So I
Mm-hmm.
think that's one of the issue. But you're right. Now is a good time. This is discounted by a pretty good discount price, right? I mean, what are you seeing now in a discount price and we can buy now?
Well, what I'm seeing now is that we are currently experiencing a wave of new apartments coming to the market.
Okay.
And you read articles from different publications, and they're gonna back that up, right? That's what that's some that sells clicks, that gets clicks, talking about how there's so much supply hitting the market in apartments, and they are absolutely right. To give you some numbers, the for the average calendar year, since going back to 2000, for the
Hmm.
average calendar year, 217,000 completed units hit the market for the
Wow.
average. So 217 for the average calendar year. But listen to this: for the only half of this year, 284,000 apartments have been completed. Just half
284.
of this year,
Oh,
284,000 have been completed, but the average for a full calendar year is 217. So we've surpassed the average for a full calendar year just in this first half of the year. So absolutely, there's tons of apartments flooding the market. But
hmm.
here's the kicker. The kicker is that the average occupancy
Hmm.
with all these apartments coming to the market at a historical level
Hmm.
is 94.2%.
Really?
And
Wow.
and it's held steady at that exact percentage the last 3 months,
Wow.
94.2%. So what's that tell us? Well, it tells us there's a bunch of demand. There's a ton of supply relative to the last 23 years,
Hmm.
but
Yes.
there's demand that can absorb that supply. And so what happens when that supply turns off? Well, you've got a lot of demand, but not a lot of supply. And what happens when you have a lot of demand, but not a lot of supply to prices, right? They go up,
Yeah.
rents go up. And we're about to experience that because right now, the completions far outpace the starts for this year. So much so that there's almost 60,000 more completions. And I have stats on this I can share with you if you want to share with your audience in the show
Sure.
notes or whatever.
Sure.
But there's almost 60,000 more starts than completions. Or excuse me, almost 60,000 more completions than starts for this calendar year.
Wow.
That's the biggest difference since the 1970s.
Wow. Well, that's pretty
And I
amazing.
mean, it is amazing. And you know
Yeah.
why? And it's because of the interest rates, and construction projects don't pencil right now.
Mm-hmm.
So we've got a major need for housing.
Yep.
We have occupancy holding strong at 94.2% when a once in a generation supply wave hits.
Hmm.
Well, what happens in about 12 months when the interest rates projects that were penciled in 2020 are now completed? You're not getting another wave
Hmm.
of new supply hitting the market, and you're going to see an incredible time to be a multifamily owner. You
Yes.
will. It's
Yeah.
just, and this is something that, barring some black swan event,
Hmm.
it will happen. It's just you can see when someone gets a permit to start a new apartment,
Hmm.
and then that takes about 18-24 months from
Yep.
start to finish. So you see it well in advance. And it's just a simple supply demand dynamic. And so that's a macro level um, insight that will happen. But now, as investors, I'm an LP. I'm an LP on over 120 deals. I'm
Wow.
also a GP. So as an LP, I think, okay, that's interesting. What do I do about? How do I take advantage of it? How do I capitalize on it? And so when we're looking at deals as LPs, it's necessary to ask the GP, hey, tell me about the supply demand dynamic in this particular submarket,
Hmm.
because we want to make sure that aligns with the macro level trend.
Okay. Okay. Good. Good. Yeah, it's good. So what lessons do you learn as a 120 LP deal? I assume you 120 deal, which is a lot. Very significant. That's probably most only person I know has 120 deals in LP that I know. So what did you learn over the years as a passive investor in multifamily?
Well, I have learned that um, bigger isn't better. So smaller deals like 30 units, if I invest $100,000, my $100,000 doesn't care if I'm investing with an operator that has a 30 unit property or 300 unit property. It just cares about the end result.
Right.
And so I think I don't buy smaller properties. So, this doesn't help my company's cause, Ashcroft Capital. I'm just telling you what I see. And 300 units certainly could work, but so could 30. So I personally don't dismiss the deal due to its size.
Yeah.
I look at it on its own merit. Um, I also look for an owner operator of the deal. I want to know um, who has voting rights to make decisions on operations, and
Yeah.
then whoever that is, what is their track record, and not just what's their track record for taking deals full cycle. I want to know, of those deals that they took full cycle, what is the NOI growth of those deals? Because they might have benefited they did benefit from cap rate compression. There's nothing wrong with that. I benefited, everyone benefited who owned and sold from cap rate compression.
Mm-hmm.
But did they grow NOI? That's what, we focus on NOI growth at Ashcroft Capital and the operations,
Mm-hmm.
because you can work your way out of a lot of things and into really good stuff if you focus on NOI growth. And so I want to know, tell me about the NOI growth on the exits that you've taken full cycle. I'd say I want to understand it too. I want to understand what the business model is. Some development deals, I understand it, but there's a lot of components involved that the developer doesn't have control over, like public opinion, for
Okay.
example.
Okay.
And I won't do development because I don't understand the political dynamics and that are involved within that particular community, nor do I care to. So I just stay away from it. Uh, Not to mention, there's all sorts of other challenges that could take place with turning dirt into something that is profitable and people, has a structure that people live in.
Mm-hmm.
And of the 123 deals I'm in now or so, I'd say the development deals by far are the worst type of investment that I've done. Fortunately, I'm in like three, I think, but uh, they're all bad.
And
Um,
and why do you think so? Because they couldn't control the timing, GP was bad, or they didn't, the project went sideways. What happened there, you think?
I think, well, one thing is um, investing, depending on what stage you invest in during the development deal. Investing when it's just an idea, uh, and they're trying to get financing. There's a lot that can go sideways there versus investing maybe, later on once they've got financing secured and now they just need to take a shovel to the dirt. But still, I wouldn't do it. It's just there's just a lot that can happen before you are profitable. It's just a longer period of time. It's just like if you do a fix and flip on a single family home and the market turns, you're stuck with a property that is not rentable unless you fix it up and spend the money, and then you got to rent it out, and then you got to do a different business model than you planned versus just fixing and flipping. Fixing and flipping's great as long as the market cooperates and you're in and out quickly. But if the market turns or your approvals, don't happen as quickly, or you find some stuff behind the walls that you didn't think you'd find, that's that'll sidetrack things. Same with development. Um, it's it's just been a bad experience from the
Okay.
development deals I've been on. So I won't do ground up development
Okay.
anymore. I do want to make a distinction though, and we don't do development at Ashcroft Capital. But I do like investing passively in um, lease ups. So after the property has been built, the lease up period, that is when you buy the property from the developer and
Mm-hmm.
they're leasing it up, I think there's value you can add to
Okay.
that. You buy it at a 50% occupancy and you lease it up to 95%, like getting that value there. I think, you're buying a brand new property, right? It's like buying a brand new car.
Mm-hmm.
So I like that approach. I'm not in too many of those deals, but I enjoy those.
Okay. So out of those multifamily deals that you're in as an LP, I know you've seen like bridge loans, rate cap expiration, capital calls. How many capital calls were you personally been into?
As a LP, I've been asked to do four, and I've participated in three of the four.
Okay. Right. Because if you don't participate, you dilute your shares basically, right? If you don't participate in the.
Yeah. And it depends on the operating agreement. But I mean on the fourth one, the one that I didn't participate in, they got foreclosed on. So, you know, that
Oh,
the dilution was irrelevant because my 100,000 went to zero, along with every other investor that invests with them. And again, just so I'm being crystal clear, I'm an LP on that
yeah,
deal.
yeah,
I'm an LP on that deal that where that happened.
right.
But
Unfortunately, yeah.
the other three I participated, and you know, it's I have faith. I have faith in the operator. I have faith in the plan, and I have faith in the market. And that's what I look at. Do I have faith in the operator? Well, first, do I have faith in the plan? And do I have faith in the operator to execute the plan? And do I have faith in the market? And when I say market, I mean the area that the property is located in.
Hmm.
And so if I have faith in those three, then I proceed. And, like I said, 3 out of 4 I've proceeded with, and um, all the three that I've proceeded with made sense to me,
Okay.
made sense to do it.
Good. So, okay, so and then how did Ashcroft, because I love the fact that you're vertically integrated, which a lot of big firms do that because you need quality and control, basically. But how
Mhm.
did you, at what size do you recommend someone like me to begin vertically integrating? And what size and what level and the path to that?
How quickly do you want to experience pain?
Oh, I see.
It's
I see.
hard. Yeah, it's expensive and it's hard and it's stressful, but it's worth it because you have better operations. Uh, no one's going to take care of your properties like you take care of your properties. We have Birchstone Residential is the property management company that we created. They exclusively manage Ashcroft Capital's properties. That's
Mhm.
it. And it's expensive to do, and it's a lot of work. My business partner was the one that spearheaded that. I did not, uh, but we've all benefited as a result of it. The size, um, it depends on your background.
Mhm.
I mean, I have friends here in Cincinnati who started out fixing and flipping homes,
Okay.
and they grew a residential portfolio, and they're hands-on, swinging hammers and using saws and all sorts of stuff. You can tell how I'm talking about it. That's not my area of expertise. When I say using saws, but I don't even know if people. Yeah, I guess you use electric saws. I was thinking of the ones like the hand saw, but uh, they have been vertically integrated from the beginning because
okay.
that's just how they roll. That's how they came into existence.
Hmm.
And now they do large apartment buildings, and I passively invest with them.
Okay.
And then there's others who uh, don't have that background and experience. So you got to have people on your team who have that. So
Hmm.
you either have it or you hire it,
Hmm.
and that can be expensive, and so it depends on the situation, um, because it depends on your portfolio. Because if you have, say, you're spread out across 3 different cities and you got a property in each city
Hmm.
starting out, I don't recommend having your own management company, because how are you going to get efficiencies? I think, just have three regional, really good regional management companies, or get a national management company that's in each of the 3 markets that you're working
Hmm.
with.
Yeah.
It's I think when you have a high concentration of properties, and how do I define high? I don't know, maybe 1,000 units
Yeah.
in a market,
Yeah.
then you are a glutton for punishment, and you're ready to make your life spicy, then take a look at doing your own management company.
Okay, I see. I see. I feel a lot of pain. Okay, I see a lot of it's not easy. It's not easy. Okay. Yeah, it's definitely not easy. Okay, great. Great, wonderful. So what I guess advice to my audience if they want to start out or be either GP or LP, what advice would you give them as a GP starting out? What was the best ever advice you give them?
As a GP or LP starting out, I would say, I would say, identify those who are doing what you're seeking to do, and learn from them. That's what my advice. That's
Yeah.
my advice because that's what has worked for me. Of I don't I have not recreated a wheel. I have simply watched how others have done it, and then I've learned from it and attempted to do it myself. Sometimes
Mhm.
successfully, sometimes unsuccessfully, but I'm always learning.
Okay, great. And how do you define life?
How do I define life?
Yeah.
Um, if I'm breathing, there's
Okay.
life.
Okay. Okay. Good. Good. And then
I know I guarantee you that's not the intention of the question, but that's just the answer that I thought of. So
okay, no problem, no problem, Joe. And I guess what was interesting, you said, let's go back to the point where you said that you did you did the fund model and that worked very well for you, I assume for Ashcroft, the fund.
Mhm.
And you did it with you said three funds or two funds so far?
three, three.
Three. But now you said that you have one in Orlando, but you started single act because you weren't sure if there was enough deal flow to continue the fourth fund. Is that correct?
That's correct.
Okay. Okay. Good. Interesting. Good. Okay. Great, Joe. So how people reach out to you to want to talk to you and contact you?
Well, you can go to ashcroftcapital.com
Yeah.
and we have that deal that I referenced. It's in Orlando. We're closing on it in about a month and a half to 2 months.
Okay.
And 5.5 cap, beautiful property, 2021 construction. Tenants make 115K, a school district, and there's some pretty good upside in it. So you can go to ashcroftcapital.com. You can see a video on it by clicking on current offerings, and you can schedule a call with the team and learn more
Mhm.
about it.
Is it a 506C, accredited investors only? Okay.
It
Okay.
is.
Great. Thank you very much, Joe. Thank you for your time.
All right. Enjoyed our conversation. Thanks, everyone.